The first topic for today's conversation is about yields and the relationship different yields have over time and how that can actually tell you very much about the economy. So, in the upper left here, we have all the different bond futures, the long dated bond, like 20, 30 years, 10-year, 5-year, that's all these different colors. These are the prices. And then on the right-hand side here, these are the respective yields. And remember from the part 1 of this bond tutorial, you should understand that, of course, yield is a function of the coupon that's attached to the bond and the bond's price. And the bottom line here is the yield and the price are exactly inversely correlated. They have to be. And if you need to go back and review that video that I produced on how bonds work and how yields work and bond prices, then do so. So the first part of our conversation today, the yield curve, is simply asking what is the relationship of these yields in relation to each other. And that is why we look at, this is sort of a line chart where you can see them, and you can see like the yellow one zipped up higher here than the blue one, then the yellow came back down, is now below the blue one. You can see that these relationships are constantly changing. And the graphical demonstration of this, and what I think is an extremely powerful tool for investors, is what we call the dynamic yield curve, or really the yield curve. Dynamic is because this thing, they've made it so that it moves. But basically the yield curve. And you'll notice that the yield curve, in essence, the relationship between these different yields, right? Yellow one, and in this particular case, yellow is, what the heck is that? Can't even see. Brian's an old man here. The yellow is 5-year, the red is 10-year, and the blue is the 30-year. So very simply put, let's zoom in here. In this case, 5-year yields, right, were lower than 10-year yields, were lower than 30-year yields. And actually, while we've got this up here, right, this particular spot right here we're talking about, this is basically an example where shorter term yields, shorter duration yields, are lower as we move out through the curve. The curve looks like this, right? So this is a 3-month, 2-year, 5-year, 10-year, 30-year, right? And in essence, yields are rising as we go out the curve. This is what we call normal, and this is healthy. In fact, basically, as long as we have a normal and a healthy yield curve, you're going to notice that the stock market is going to move up. Why? If we think about it in the most simplest terms, a big part of the stock market is made up of financial companies. They might be insurance companies, they might be banks, they might be mortgage companies, they might be reinsurance companies. But a big percentage of our modern day capitalist system is in nothing more than the business of money. I mean, that's as simple as it gets. And what businesses usually do in the business of money is they borrow at the short end of the curve, right? And they constantly reinvest. Every time the short duration borrowings expire, they just go out into the short end. They just keep reinvesting. And they lend out to the public at the long end of the curve, right? So like in this particular case, if I was like a bank or something, right, I'm going to lend out to Joe Sixpack at 3-4%, right? So I have a net liability. I lent him the money at 3-4%. So I'm going to go into the marketplace on a daily basis and borrow to cover that liability, right, at the short end of the curve. And, you know, this might be like 90-day paper, right? And then in 90 days, I do it again. And in 90 days, I do it again. So as a bank, I have no liability here. I've lent this money out to the public, but I borrowed it at the short end of the curve. My balance sheet is basically a net zero. In this situation, can you understand that quite literally this is their profit margin? And if they do this and the yields on the short end of the curve stay low, then in essence, if they do it through the entire duration of the term, this is their profit margin. You know, if it's on like a $500,000 mortgage or something, you know, that's some serious money. That is their profit margin. And this is how basically the entire financial services industry works. So this is a normal curve. And as you can see, the stock market has just worked its way higher. And it's interesting how the volatility of the market, you know, has calmed down appreciably as the sort of curve just sort of, you know, flattens out, but maintains this normalness, right? Like through this period, look how steep this was, right? Really, really choppy action. And then as time goes by, you can see businesses just sort of slowly get comfortable with the cost of doing business, right? And things sort of, the volatility sort of comes out of the market. All right, so that is a normal state. Just for example purposes, you know, of day to day, but let's see if we can just find a situation where maybe that wasn't the case, just in the short term here. All right, so here you can see in this particular example over this reporting period, the 5-year yields were higher than the 10-year yields were higher than the 30-year yields. Something's wrong there. So if we go back to our yield curve and we find a situation where that's the case, what does it sort of tell us, right? And so what's interesting here is this is the dot-com boom. Economy's roaring, Fed's raising short-term interest rates. And so we actually at some point get a curve where, here's a good example here, inverted, where the cost of borrowing on the short end of the curve is actually higher than the cost of lending out on the longer end of the curve. So in this particular case, can you understand, for one big part of the stock market and a big part of the economy, they are actually guaranteed to lose money, right? And I think there was a point where short-term rates, let's just see, were actually higher than long-term rates. Can I move that over? You're going to move over? Where is it? There we go. All right. This is just sort of like the absolute worst case scenario for financial services industry. On the 90-day paper, which they absolutely have to do, they have to reinvest at these levels, and so they are locking in a loss relative to the money that they lent out to the public. And look what the stock market did shortly after that. Kaboom! So the point here, guys, is that if we ever get into a situation where you see that the yield curve goes inverted, it's almost guaranteeing that the stock market, and keep in mind the financial services industry, shit runs downhill. They're going to start laying off employees and firing traders and all that kind of crap, right, as their bottom line gets squeezed. And that just has a trickle-down effect through the market, right? Venture capital seizes up, and that means no more lending out, you know, in the marketplace, right? Because they're going to go, I'm not lending money at these rates. And the economy just unwinds. So the question would be is, why on earth would the Fed allow this to happen? Remember, this was the dot-com boom. The economic cycle, right? If we, let's see if we can just go back. I think I have it here. Maybe I have it on this page here. Images, right? The business cycle. The Fed's primary concern at any given point in time is the relative purchasing power of the currency. So if we're at the absolute top of the economic cycle and everything's roaring, and you know, if you guys even remember the dot-com boom, I was a broker through it. I mean, it was rah, rah, rah. It was good times. And sadly, of course, that's when the Fed starts to worry about inflation and starts to worry that, hey, maybe things are going a little too fast. And their solution, right, to things growing too fast is to basically engineer a recession in a certain part of the economy. By raising short-term interest rates like this and absolutely guaranteeing losses in a certain part of the economy, they can force this market to calm down. And calm down usually is a recession. And then the irony of it all is once they've sort of calmed things down, watch how quickly they go, okay, oh, okay, let's put everything back to place, right? Instantly the market starts breaking and you can watch the yield curves collapsing. It's going to do its own thing. And then, of course, we have things like 9/11 and stuff that all come in here. But basically, the Fed got what it wanted. And then you'll notice, you know, really through this period, it's almost like chaos. If we have a situation like this, and this was shortly after the initial break, this is what we call a flat curve. Even though short rates are still too high, you can see that, you know, on the part of the curve is pointing up, but also part of the curve is pointing down. If you see it, and this little engine will tell you it's flat. It's just a, hey, you know what? Let's just let things settle down a little bit before we get too excited. But ultimately, the curve, and you can literally see the Fed panicking in here, right? They had rates way up here, and look how quickly they started to bring rates down. Okay, we've got our objective. We broke the backs. Okay, now, okay, so they're still selling. Okay, let's bring rates down. We're, and then 9/11 comes along. Oh, shit. Okay, maybe we got to lower rates. Okay, now, can you see how, like, at this point here, now we're like, you know, a few years later, the stock market's collapsed. And now the yield curve is back to that absolutely guarantee the financial services industry is going to make money. And so the market goes, okay, fine, you know, put a few quarters together. The Goldman Sachs's, the Merrill Lynch's, the JP Morgan's, they start showing profits, right? Because they're absolutely guaranteed to make money quarter over quarter, right? And so then they start lending out money, you know, they start doing venture capital, blah, blah, blah. And away we go through the cycle again. And you can watch as we sort of, as the economy picks up steam, right now we're in this next cycle, as the economy is picking up steam, here comes the big bad Fed, right? They're starting it, you can see them, they're starting to, okay, now we can start raising interest rates again. And what they really want to do is just manage things so we don't get too excited, right? We got flat warning here. So, you know, in 2006, this is 2 years before the meltdown, we're starting to get warnings. Hey, pay attention, something's not right. At this point, the Fed has now said to the financial services industry, no more slam dunk profits. You know, it's going to be a slog. You know, start tightening your belts, boys. As the market, and keep in mind, the market, think of the market just as it was on the way down. It didn't stop instantly and start head back up. It actually moves on. Think of like the ocean liner out in the open ocean. Takes about 10 nautical miles for that ocean liner, you know, steamship, whatever, to go from full speed to full stop. Takes 10 nautical miles. So same thing in the stock market. The Fed at this point in 2006, you know, they see what's going on in the mortgage market and they're kind of like, hey boys, slow things down. But the steamship has such a head of steam behind it that it's still going, right? And the yield curve's still flat, caution, 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 right? And then look how rates, now they've actually taken rates above longer term rates. This should be a major warning sign to investors. And then if I'm not mistaken, we actually do get the curve. Does it actually invert here? I thought it inverted somewhere in here. We did get a warning. Where is it? Somewhere along here. That the curve inverted. Where is it? Oops. I didn't see it. Anyway, somewhere in here. I don't want to spend 10 minutes finding it. there was an inversion warning in here. I seem to remember. There it is, right in there. So that is February of 2007. The curve officially inverted. And what's really interesting is I used to run a blog on the S&P 500, and I can find anybody if you want, just ask me. We actually got a sell signal. The moving averages crossed bearishly in March. So 1 month after this inversion warning, right in here, we got the moving averages started flashing sell signals. And of course, you know, if you had slowly gotten yourself out of the stock market, look what you avoided, right? Vaboosh, right? And what's really interesting is, again, you know, major warning signs from the Fed. Hey, financial services, be careful. We want to slow things down, right? We're back up in this peak area. We want to slow things down. And if you had listened to this, you would have just slowly gotten out of the stock market. And of course, as the market's breaking, the Fed sees the break. Okay, phew, finally we've taken the steam out of the market. They bring rates down. But think of Open Ocean Liner, and unfortunately, this was the end of Junior Bush's term, and Obama's standing up, change, we're going to change everything, and the stock market crapped its pants, right? And think Open Ocean Liner, right? Where the hell is this damn thing going to bottom? The new president comes in, and it turns out, well, it's really not going to change much. In fact, he actually just got the taxpayers to foot the bill to buy all this bad debt that was floating over the market, right? Quantitative easing, all that nonsense. And as soon as that the market saw that basically the credit taps were turned back on, yield curves nice and healthy again, normal, put together a couple quarters of profits from the financial services sector, and here comes the bull again, right? Same thing. So I hope this gives you a really, really good sort of lesson on how these yields and their relationship, i.e. bond prices, because keep in mind, yields are basically directly inversely related to bond prices, how that translates into how we can use this as information to tell us where we are in the cycle and what the Fed is thinking about the economy and what it wants to do.